Welcome to today's video where we're going on a journey through the world of investments. We'll be looking at the differences between two very different types of opportunities, investing in cryptocurrency and traditional investing. If you'd like to skip to a specific topic, check out the chapters in the description. With the rise of digital assets like Bitcoin and Ethereum, many investors are wondering, is the future of investing in cryptocurrency, or are traditional methods still the best choice for stability? The answer? It depends on the investor. What factors make the cryptocurrency market a good or bad investment? In this video, we'll explore the main features, advantages, disadvantages, and risks of each type of investment to help you decide which one might be right for you. Whether you're looking for quick returns, security, or diversification, this guide will give you the insights you need to make an informed decision. And remember, if you want to learn more about the topics covered in this video, check out our curated playlists for every level and type of investor. So, get ready, buckle up, and join me as we explore the world of cryptocurrency and traditional investing. Let's begin. Before we compare crypto and traditional investments, let's first understand what the crypto market is and how it differs from traditional finance. The crypto market is new and dynamic, involving digital assets based on blockchain, a decentralized technology that records transactions securely. It emerged as an alternative to traditional finance, allowing transactions without middlemen like banks. It's important to know the difference between crypto assets and cryptocurrencies. Crypto assets are all digital assets using blockchain. For more on this technology, check out our video in the card. Cryptocurrencies are a type of crypto asset, created to be digital money. Bitcoin and Ethereum are examples of cryptocurrencies, used as alternatives to traditional money. There are other types of crypto assets like utility tokens, which give access to services or products, and stablecoins like Tether, which are linked to traditional currencies to offer stability in the volatile crypto market. Now let's talk about traditional investments. Stocks represent ownership in a company, allowing investors to benefit from profits. Bonds are loans to the government or companies, where investors receive interest. Mutual funds combine different assets in a portfolio managed by a professional, and real estate is a tangible investment generating passive income. In short, the crypto market is a digital innovation, with decentralized and fast-evolving assets, while traditional investments are well-established, highly regulated, and well-defined. Both have pros and cons, and the choice depends on your profile and goals. Now that we understand the basics, let's dive deeper to find out which investment suits you best. Now that we know about traditional investments, let's look at cryptocurrencies, a market full of opportunities and risks. This market attracts investors looking for innovation, big returns, and financial freedom, but it requires attention and knowledge. Cryptocurrencies are a great way to diversify an investment portfolio. Unlike stocks and bonds, they often move independently and aren't affected by global market changes. This helps reduce the risk of losing money during an economic crisis. In a crisis, traditional assets can lose value at the same time. Cryptocurrencies work on a decentralized and global network and can increase in value independently of traditional markets. Bitcoin is seen as digital gold and is used to protect portfolios. Check out our video about Bitcoin in the card above. Crypto transactions are cheaper and faster than traditional banking, especially for international transfers. Instead of paying high fees and waiting for days, cryptocurrencies allow almost instant transfers with lower costs. Cryptocurrencies offer secure and anonymous transactions through the blockchain. Each transaction is recorded transparently and publicly, but user privacy is maintained. When you shop online with cryptocurrencies, you don't need to provide sensitive information, reducing the risk of identity theft. By operating on a decentralized network, they give investors complete control over their assets, eliminating the need for intermediaries. The volatility of cryptocurrencies attracts investors who are willing to take risks. With large price swings, it is possible to profit by buying low and selling high. However, this volatility also involves risks of losses. The acceptance of cryptocurrencies as a means of payment is still limited. Although large companies accept Bitcoin, most businesses still do not use these currencies. They operate in a largely unregulated environment, with no official investor protection. This market is still young and uncertain, with government regulations and technological changes affecting its value and stability. In 2021, China banned the use and mining of cryptocurrencies, causing a drop in global prices. Therefore, investing in cryptocurrencies requires technical knowledge about digital wallets and security. Another important technical aspect is the analysis of white papers. This is the official document that presents the proposal for a new cryptocurrency or blockchain project, detailing the problem that the project intends to solve, its technology, the economic model, and other fundamental aspects. This document is like a Bible for investors because it provides all the information to understand the potential, risks, and functionality of the project. The extreme volatility of the crypto market represents both an opportunity for large profits and a significant risk. For some, the possibility of quick returns and control over assets is attractive. For others, volatility and lack of regulation are barriers. Now let's directly compare the crypto market with the traditional market so you can decide which option best suits your profile and goals. Now that we've looked at ways to diversify within the crypto market, let's see how to add these cryptocurrencies to a complete portfolio. balancing safety and potential returns. Cryptocurrencies can help protect against traditional market ups and downs while boosting growth potential. They often don't move in the same direction as traditional markets, so they can go up in value even when other markets are down. How much of your portfolio should be in crypto depends on your risk tolerance and financial goals. Conservative investors usually keep crypto to about 1 to 5% of their portfolio. Moderate investors might allocate 5 to 15% to crypto, balancing risk and reward. High growth seekers can go up to 20 to 30% in crypto, aiming for long-term gains. This can change based on comfort with the market and crypto performance over time. It's important to mix crypto with traditional assets for a balance of safety and growth. Traditional assets provide stability and can offset the volatility of cryptocurrencies. A portfolio with 60% in stocks and bonds, 20% in real estate, and 20% in crypto offers a good mix of growth and safety. Diversifying the crypto part of your portfolio is key to reducing risks. This includes spreading investments across different assets, sectors, and market caps. Invest in Bitcoin, stablecoins, and altcoins for different levels of risk and stability. Invest in sectors like DeFi, NFTs, and Layer 1 protocols to protect against risks in any one area. Combine large-cap cryptos for security with small-cap cryptos for growth potential. Even with diversification, crypto is risky and needs constant management. Diversifying across different assets can lower, but not eliminate, risk. Changes in regulations can greatly affect crypto values. Use strong security measures like hardware wallets and trusted platforms to protect your crypto. Diversifying with both crypto and traditional assets is a good strategy to get the best of both worlds. With careful planning and risk management, you can create a portfolio that balances growth and security. So, we've reached the end of our journey exploring traditional and crypto investments. To wrap up, here are some practical tips for building a diversified portfolio with both traditional and crypto assets. First and foremost, understand your risk tolerance. Knowing if you're a conservative, moderate, or aggressive investor will help you determine the right amount of crypto for your portfolio and define diversification strategies that match your goals. Second, especially if you're new to cryptocurrencies, start with a small investment and gradually increase it as you become more comfortable. Remember that diversification is an ongoing process. And lastly, keep track of your portfolio's performance and adjust your asset allocation based on market changes and your own investment goals. We hope this guide has helped you understand how to navigate this complex and exciting world of investing. Good luck on your investment journey. If you enjoyed this content, don't forget to like, comment, and subscribe to our channel. By doing so, you help us continue to bring you more content that can make a difference in your daily life as an investor. And of course, we love to hear your feedback and answer your questions. We also want to invite you to join our growing community. Explore our other videos and check out our carefully curated playlists that cover topics from beginner to advanced. That way, you can continue to expand your knowledge and connect with other investment enthusiasts. Thanks for joining us. We hope to see you in the comments and in our upcoming videos. See you next time.